Now, S&P sees the Philippines benchmark rate coming down to 4.75% this year, implying a total of 100 basis points worth of rate cuts. S&P Global last November affirmed its BBB plus long-term credit rating for the Philippines, but raised its outlook to positive from stable. Well, with us now for more from Singapore is S&P Global Ratings Asia Pacific economist Vishrut Rana. So good to see you, Vishrut. Thank you so much for joining us.
Thanks, Kathy.
So I was reading your report and saw that you're expecting the Fed to cut the policy rate by 25 basis points this year, and that's it. Now, the Fed funds futures are pricing in more than 25 Fed rate cuts for the year. So why the more conservative view, Vishrut?
Right. No, that's an excellent question. And of course, the Fed drives a lot of the Asia Pacific central bank decision making as well in terms of influencing the path of capital flows. So an important variable that we watch out for. In the United States, we continue to see relatively elevated inflation pressures, especially underlying inflation. In addition, the uncertainty caused by trade policy may lead to higher inflation, in our opinion, also. And as a result, we are expecting the Fed to be cautious in terms of easing interest rates. We continue to see relatively resilient activity in the U.S. economy, which means that from a growth front, the Fed isn't currently under pressure to be easing rates as much as the market currently expects, and hence our projection for just the one rate cut. For the Philippines, we see the policy rate ending up at 5.25% towards the end of this year and 4.5% next year. So still a little bit more aggressive than the Fed, but not highly increased relative to the U.S. interest rates also.
But it is a little bit aggressive, as you say yourself, Vishnu. Just mirror that with the Bangko Sentral policy rate cut expectations, a total of 100 basis points for the full year. That's a lot bigger even than the Bangko Sentral's own signaling. So how would the Bangko Sentral be convinced to cut more than that?
So we don't project 100 basis points of cuts this year. We project 50 basis points. So we expect to end the year at 5.25%. A number of factors are driving the BSP's decision making, I think, in the current environment. For the Philippines, what we see is that in the later half of 2024, we saw some softening of the domestic activity, particularly domestic demand. We have started to see some of that start to come back online towards the start of this year. We're expecting economic activity to improve in 2025, so we project around 6% growth this year, higher than the slightly north of 5% that we had last year in 2024. In that environment, inflation still remains very much under control. So the BSP has flexibility to ease interest rates. On the other hand, the capital flow environment is still quite uncertain. There's still capital outflow pressures. The currency has been broadly stable, but the BSP will not want to move too quickly to avoid the risk of triggering capital outflows, particularly while the U.S. Fed and interest rates remain relatively elevated.
All right, so you're saying that Trump's trade policy will squeeze or strain, but not choke growth in the Asia Pacific. So where does the Philippines stand then within the ASEAN when it comes to the depth and the breadth of the impact of Trump's tariff policy?
Yeah, that's an important consideration for us in APAC this year. Of course, the outcome of trade policy and how economies are relatively positioned. A number of APAC economies are very trade-oriented. They depend on external demand for driving their growth. The Philippines falls somewhere in the middle in that group, slightly more towards the domestic orientation in terms of its economy. Compared to peers, for example, Malaysia, Thailand, these would be more externally oriented economies. Vietnam is an outlier, very externally oriented economy, relies very much on US demand. The Philippines, less so. Indonesia, even less. So these two economies have relatively lower external reliance and as a result, a little bit more sheltered from trade developments. Two other quick points that I want to mention for the Philippines. One is that there's greater reliance on services trade, right? Things like business process outsourcing, and tourism, etc. These service exports are sheltered from trade measures, which is a benefit. And also, the Philippines does not run a large trade surplus with the US and may not be on the radar for US trade policy.
All right, we'll keep an eye on those shelters in tourism as well as services. Vishrut Rana of S&P Global Ratings in Singapore, thank you so much for joining us.